Welcome to Behind the SME, the podcast where we dive into the stories of founders, leaders, and visionaries of small and medium-sized enterprises. As the CEO of a small business myself, I want to uncover what drives the success of SMEs by talking to those who are in the trenches, building their businesses from the ground up. I hope you enjoy the episode. Jonathan, welcome to the podcast. Thanks so much for joining us.
Thank you very much. Nice to be here.
So, bit of context, you and I have been working together in a kind of advisory capacity for 4 or 5 years now.
Yeah, it's been good to see you grow and the business grow. It's been exciting.
Yeah, and your contributions are always valuable. You're one of those people that in a room of 10 people, you'll sit there, listen, take it all in, and then there'll be a moment where kind of everyone looks at you and you go and you come out with something really profound. And everyone
sometimes
everyone listens and go, that's a really, really great point.
Yeah.
So always value your guidance.
Thank you.
And I'm really happy that you can spend some time with us this morning. I think we're going to have a really interesting conversation. You've got a unique angle that we want to hear from, but instead of me trying to summarize your impressive career, why don't you give us just a quick rundown of what you've been up to?
Sure. Yeah. So I started in the finance world. So I started in the capital market space within the banking universe. In the first really 22 years, mixed between New York and London. And I came up through the capital markets and trading world, which is quite different from the investment banking world. And that might inform maybe how I look at investments and those kind of things later in my career. But I started through that, which is a very hands-on trading, investment decisions type of world. And over the course of that career in banking, moved up into management. And so by the time I sort of left day-to-day banking, I was running a group of 300-400 people across a global business within very large banks, right? Merrill Lynch, Bank of America, and Barclays. So I definitely saw the pros and cons of working for a really large organization and all the things that go with that in terms of managing a business within it. I left day-to-day banking really for, I would say, lifestyle reasons. I had 3 kids. They were at that age where they were becoming really active and a lot of things to do. And those kind of careers and those kind of jobs were all consuming. And I was kind of worried about the work-life balance, which I heard you talk about nicely in other episodes. I then moved into spend some time at a hedge fund. So a totally different environment from the banking world. Hedge fund, and also at the same owner was also a fintech company where we sold software to asset managers. And that was really my first change from a really large organization. A hedge fund is run very different than a classic SME or a classic kind of small business. But it was, 100 type size people. So the dynamics are really different from a large organization with hundreds of thousands of people.
Sure.
And the fintech company was kind of a classic startup, right? It was started with 10, 15 people, grew to 40 or 50, and all the benefits of a startup and all the struggles with a startup. And I was chairman of that company, and we eventually sold it to another fintech company in the sort of regulatory reporting world. But that was, again, the first experience of really being on the board of a small company and thinking about the dynamics of what the investors want and the staff want and the funding required and all of those difficult dynamics of I think, starting a business. Around the same time, I spent a lot of time with my own personal investing. So I'm an investor in an LP in private equity funds, venture funds, a lot of other slightly obscure type investments, and then also invest in individual companies. And now I spend, I would say, the majority of my time with one of the companies that I'm on the board of and an investor of called TMTID, that's in the telecom data kind of fraud and identity space. And that's been a really great journey because I've been sort of with those guys, a little bit like with you and your advisory board. I've been really with them since they started, which is in 2017, and been on the board and now do advisory work for them. and have seen them grow and think about, have a lot of success, but think about their challenges. What do they want to be as an organization? What does the founders want? It's pretty much a bootstrap company. So I think, in your family and you love those kind of stories. And now spending a lot of time with them, talking to advisors and potential investors and thinking about where the company can grow and how we might grow it.
Nice. I mean, I think where I want to take this conversation is, huge portion of your career in big companies, and then you've had this amazing helicopter view of lots of different types of organizations, how boards are structured, the type of investments that people might take at different times of their growth journey, and which ones have gone really well, and maybe some lessons learned in that as well. So I guess a slightly different perspective than we've had on the podcast before. So yeah, I want to crack on with some of these details, but let's first start by talking about the difference that you recognize in big, massive conglomerates and some of the smaller companies, and what your reflections are, having spent now a decent amount of time in both types of business.
Sure. Yeah. I mean, there's obviously pros and cons of both. I think the most obvious pro, I think, of a large organization is your ability to invest, right? Your investment horizon is just by definition longer. And you depend on the organization and depend on your division or your area, you tend to have more flexibility, right? You tend to have more diversified revenue. You tend to have access to capital, right? Internal capital, much easier. And so your ability to think, where is my market going in 5 years? And where do I want to take our product, our infrastructure, our technology, whatever it is? It's not easy to make a decision, but once you make a decision, your ability to execute that is much easier. When you're at a startup or even just a sort of SME of a smaller scale, you just don't have that luxury. You might have a great vision for where things are going to be in 5 years, but you are living month to month. You have to have revenue. You have to have traction to keep your staff, to keep the clients, those kind of things. And so I think that was the first observation when I went away from large organizations, was that you just don't have that luxury. You can't ignore it, because obviously you might be positioning your business to a space where it's not, the market isn't going, but you certainly don't have that luxury. So that's the first one. I think the second thing, which was a really brutal reality, I think, coming from a leadership position in a large organization, was your lack of resources that you can sort of, I guess, pull down, right? So when you're in a large organization, if you have a question about a regulation, legal, technology, anything, there's someone in the organization you can do, and you have to maybe use your pull of your position or use a favor, but in the end, those resources are really close to you and they're really available. And at a small organization, you just don't have that luxury. You don't have the staff of in-house legal team. You don't have regulatory experts. You don't have lobbyists. You don't have any of these things. And so the first thing that hit me like a ton of bricks, I think, when I left was I felt like I really needed to develop my network much more than when I was with large organizations. I mean, in a large organization, your network matters, definitely with clients and those kind of things, but often your network is internal. But it's just much easier to develop that. It could be investing, could be working in a small organization, you are desperate to find, how do I have a relationship with, again, a lawyer, a technologist, anything like that, to say, I need to sense check something, I need a recommendation, I need someone to give me some advice. Any of those things are much harder to come by. And I think until you don't have it, you really are surprised of how much is needed. Because it's the issues that come up are endless, and having someone who really is an expert in that area is crucially important. So those are, I think, the two immediate things that hit me, was just decision making and planning, and then that sort of network bit. I think those are the two things kind of that hit me. And I think, look, the SMEs of the world, I also think they have to really focus on what their advantage, right? And their advantage is often speed, right? because I think most people you've spoken to from large organizations, decision making and the bureaucracy, it's we debate it with governments, we debate it with large organizations. It exists. There's no doubt. And you've got a lot of advantages of large organizations in terms of scale and reach and cross-selling and everything else. But ultimately, SMEs can move really fast.
Sure.
And I think it's always good to, play the game back from my days of trading. You have to understand where you have an advantage and play in that area. And that's the number one thing I've seen with SMEs. They can move much quicker. They can adjust, pivot, whatever, language you want to use. And I think that is really valuable. And I've seen really good entrepreneurs or just managers at SMEs really adjust quickly and move their business much faster than large organizations can.
Yeah. I've worked with people in the past that have come from a big company and really struggled to adapt to the SME environment, to the extent that you might even consider using the word institutionalized. How did you adapt from that during that transition?
I think the first thing you do is you have to be willing to have your ego take a hit.
Right.
I really, it sounds so simple, right? But I think when you're in a large organization, it's very easy to feel, powerful because you have a lot of resources at your fingertips, right? And if you are managing a large team, a lot of people work for you. So, when you're asking for something, if you're asking a favor or someone to do something that works for you, it's quite different than if you're asking someone who doesn't work for you. And I think that that's really simple, but I would say that's one of the things that people struggle with.
Sure.
And so I think you have to be humble. You have to be willing to put yourself in uncomfortable situations, ask questions that you didn't realize. In a large organization, you might have your CTO give you a summary. That doesn't mean you're speaking to the developers, right? You're not speaking to the engineers who are writing the code. So the language that they use or the issues they face are just maybe hidden from you, right? When you're at a small organization, everything is there, right? And so I think you have to be willing to make yourself a little bit uncomfortable, which is just not easy because it's not what you're used to for however long you've been looking. And I think that part of being institutionalized is maybe the way it's described sometime. The flip side, though, I would say, while that can be difficult, the flip side is that intellectually you're engaged really differently. And I find that's my favorite thing of investing and working with SMEs is that you're much closer to the business, and so your understanding of things goes up dramatically. You're not going as deep in your whatever your original sector or business was, but your exposure to so many different facets of a business goes up really dramatically, and I think that's kind of fascinating. It's kind of just everyone in their career needs that kind of some new intellectual curiosity, some new intrigue, and I think that part of it's good. But you got to get over the first bit, and that's really important.
Yeah. Let's change tack slightly. Let's talk about investing. So you mentioned in your intro that you've done a bit of personal investing. What do you look for when you are deciding whether or not to go ahead with making an investment?
Well, I mean, I'd start and maybe back to, like I said, where I started in the trading world, which is the lesson that you learn there is you don't invest, you don't trade, you don't bet, whatever your language is, where you don't have the best information. And so I think, again, it's crucial to be humble, and we all may think we read a lot, we're knowledgeable, we understand parts of the world. But in most bits of investing, it could be venture, it could be public markets, it could be private markets, everywhere there are experts, right? And those experts, given their platform, given their information advantages, what they see, it's some cases, it doesn't matter how smart you think you are, you're really at a disadvantage of them. So that's the first thing I do is I sort of think, where should I try to do something myself? And where should I be looking to allocate my investments to an investment manager in some way? So I grew up trading public equities, right? I did that for many years. But would I back myself to pick stocks on a weekly basis more than a hedge fund or probably not, right?
Sure.
Because I have much lower information than I had when I was at a bank, for example, or at a hedge fund, those kind of things. So I sort of start with that lens, right? Which is why maybe I say I don't invest in biotech. I don't necessarily do real estate because I don't have experience in real estate and all the nitty gritty details of real estate development or investing, those kind of things. So that's kind of the first lens I think I look at, and then I start to look at the individual. It could be fund or it could be an individual company if I'm looking at an individual company from an investment point of view. And if I'm looking at an individual company, again, I'm into that lens. Is this an area or a company that I understand? Does my network allow me to get help in it? Right. So if it's in fintech or finance, etc., even if it's not something I don't know immediately, I have enough, my network, I can find someone who can give me some advice or feedback really quickly. But again, if it's a biotech investment, I don't have that network with enough expertise to kind of help me. And then also crucially, I think about my involvement, right? So is it something that I want to be involved in? Is it something that I could add value, right? Those kind of things. And so then that's again where you're trying to think about your investment versus involvement, and different people have different views on that. And that's a really big question, especially when you get into private investing, is what do you want? What's your goal? Is your goal to kind of write a check, do your work, and then, wait for X number of years to get your return, hopefully? Or are you looking to be more actively involved in one way or the other? And I think thinking about that as you're going in is really crucial. And every situation is different. I might want to help somewhere, but my skill set don't match. And other ones, investors or companies of SMEs, they might be really desperate to have advice or a network, those kind of things. So those are some of the initial things I think about before you get into, the nitty gritty of what's the strategy or what's the business idea, those kind of things, which is where you start.
And do you always go, you said you want the advantage of additional information. Do you always go beyond the pitch deck when you're making an investment into an individual business? Do you always want to meet them? Do you always want to ask the questions about the thing which isn't on the deck, the long-term strategy? How far do you go with it?
Yeah, it really depends on, again, this sort of depends on your situation, right? So some companies, let's say that might be getting venture funded and are really in high demand, they don't need to or want to spend time with individual investors, right? So for you to make an investment in that, even if you're able to get access, you're really investing not quite blind, but you're often having to rely on someone else who's done the diligence, right? And that's okay as well. But you have to really trust who's giving you that information, who's introduced you. It could be an asset manager, it could be a friend, it could be an ex-colleague, those kind of things. And so again, that's thinking about who's doing the diligence. Right? I prefer to do it myself and meet the founder directly and ask the questions and have a network. That's ideal. And when I don't, I'm far less likely to invest. But there are, a few examples where a good friend or an ex-colleague or someone that I really trust has done the work, has the information, and you're basing some of your investment decision, based off that. You have to balance both things, I think.
Yeah. I remember when we first met, the chap that introduced us said, try and think about every question that could possibly be asked about your business, because Jonathan will probably want to ask you. And I remember it well. And yeah, it was thorough, and I made sure I was prepped.
Well, and even that's very kind. That's very kind. But some people might call it annoying, but sometimes that's kind. But I think also even that's relevant, because I think sometimes I'll meet a founder or I'll see an idea, and I will think, in order for me to get comfortable, either I have to think, do I have the time to invest in this? And second, maybe if I have the time and I want to, is that founder or founding team, do they have the time? Right? Because it could be that I'm really interested and I've got a lot of questions and I just don't think I'm going to get it back to the level of detail, in which case then I have to sort of make a time management discussion to say, for both myself and the founder or that fund or whatever it is, if it's unlikely to match, you have to be careful before you invest 3, 4, or 5 hours of your time or someone else's time.
Sure. Okay, so we've touched on a couple of the factors that are needed for an investor, founder, business, whatever, recipient company to be successful. What else is important, do you think?
In terms of a business being successful?
Yeah, in terms of that
investment.
relationship, the shared goals being met.
Well, yeah, so I think one of the biggest issues that I think about from an investing point of view, but I also think from an advisory point of view, whether I'm a non-exec or just a advisor, is called alignment, really, right? And that's if I had to say the one thing that I think many SMEs miss is alignment, right? And what I mean by that is, if you're an SME starting out, right, then there's an obvious question. Is the founding team or the executive team aligned with the investors, right? It seems obvious because you'd say, well, the founding team pitched the story, they got investment from someone, and for them to get investment, clearly they're aligned. But often I think it's mistaken. They might be aligned on, I like this business idea, right? I want to support that, and the founding team seems credible. But the question is, does the strategy fit with the capital? And that's one of the biggest gaps. So, examples that say someone comes up and says, I really think self-driving cars are going to be, amazing, and AI is going to make all the difference. I don't disagree, but asking to raise £1 million to do that is just not realistic, right? Because the entry price of that technology is in the hundreds of millions or whatever it is. And so you have this issue where I might like the idea, I might like the founder, but if the capital that there is required doesn't match their strategy, you're quickly going to fall down. Because then eventually you'll get into this problem where the business is maybe making some progress, but to get scale of what the founder thinks, they need more and more capital. And they might not have lined up that capital. And so a lot of those discussions will be, if I meet a business or if I look at a situation, it'll be say, who are your current investors? Who are you taking investment from? And what is their goal, right? Venture capital has often very specific goals, right? They're not trying to create 10 and 20% growth companies, right? They're trying to get 10, 20x in 5 years or something, right? And so by definition, their expectations on the founder and how you're going to run that business, how are you going to invest, are you going to burn money, what kind of growth you have, is really different. If you're an investor who's put money into your business because they say that's a sensible business, I can see them making it profitable, that might be a nice lower risk, nicely profitable business, that's great.
It's very generous of you.
But that's not thank you. But that's a very specific goal.
Yeah.
And I think a lot of businesses fall down like that. And that's, in a way, that's sort of the most frustrating bit, when you see a successful entrepreneur, a successful business, and it's starting to work, or it is working, and they just can't scale or fund the business because they haven't sort of prepped their investors, or they haven't got the right investors to fund the strategy that they're trying to execute. It's a huge part of it, I think.
It sounds like, I've not been through a raise, but let's just try and put your mind let's put ourselves in the mind of that SME that's trying to raise some capital. At that point, you're going, I just want some money. I need £1 million.
Yeah.
I don't really care about where it comes from. The problems must manifest 3 or 4 years down the line when the investors are going, I thought we were going in this direction. And they're going, no, it was never really the plan.
Yeah.
The money's in the bank, they're invested, and it happens later. Yeah. Is that right? Could it be more harmful than good, having investors with the wrong strategy alignment?
Yeah, I think it can create a lot of problems, but I think the way to think about it is, if you're running an SME, you have to sort of think, what is your goal first? Your current, you as a founder, or you as a team, or you as a board, what is your goal of the business? What's your vision of the business? Growth, either burning money or profitability, geographic expansion, any of those things, product expansion. What's your goal? And then based on that, then you have to start to match what are the investors that would be a good fit.
Sure.
Right. And then you also have to layer on that, effectively think about it as, am I eligible? Right. Because if you're to get, for example, on the continuum, angel investors, venture money, growth capital, let's say private equity, right? And I'm ignoring banks for the minute, but but banks can fit in a lot of those different places.
Sure.
But each of those kind of pools of capital has a different criteria, a different scale requirement, a different timing, sort of your history of your business, and absolutely different expectations, right? So venture, we talked about, high growth. They're looking for them to get 1 out of 10, 1 out of 5 winners, right? All the way to the other end of private equity. One, you have to be a certain scale for them to really even consider it. And second, they absolutely care about the downside because they need it to be profitable. They sometimes put debt and leverage on it. They can't have a business that has 50% drop down in revenue. It doesn't work. And so everything in between that has different sort of appetites and expectations. And so I think that matching of not just, oh, I have an investor, do we agree? But it's often even before that, which is who are the types of investors I should be speaking to? That sort of weeds it out and sort of narrows it down.
Sure.
And then I guess the hardest bit is where you're taking money from individuals, because by definition, individuals are individuals. They're all different. They all have different expectations, and they might be coming into investing in your SME for totally different reasons. So then you kind of can't differentiate them based on their type of capital. Then it's really about alignment of saying, hey, I think this is going to take 5 or 7 years to build this business. It's unlikely you're going to see any liquidity until then. Are you comfortable with that?
Yeah.
Right. Or I'm profitable already. I need some growth capital, and I could see us, paying dividends and passing money back to shareholders in a couple of years.
Sure.
Either one's possible, but you need to be having those conversations when you're talking to investors.
Yeah, makes sense. So clearly, big red flag for you, misalignment. You might see a deck, hear a pitch, and you go, look, cool business, but there's a misalignment for me or the capital that I'm meant to be allocating, have available to allocate through my kind of my role. What other red flags do you have?
The founders is the huge one. You hear that from every investor. I think especially smaller size businesses, they're so utterly dependent on the founders, right? And so again, in a large organization, the organization, the brand, the infrastructure, the client connectivity, that is the main asset, right? And obviously we know that because we see large organizations survive many generations of leaders. When you get down the spectrum to in the SME world, it can go the other extreme, right? That many businesses can't exist without the founder. So that thinking about not just how does that founder look as a business leader, as a person, all of those things, but also crucially talking about alignment is making sure that founder has the same incentives as you as an investor, right? They might be thinking, I want to start a business. I don't know. I'm going to start a winery or a bar or a restaurant because I've made some money. I'm kind of semi-retirement. This might be pretty interesting. It would be fun. But if you're investing, you're not investing necessarily to be fun. You're investing to make money, but that's maybe not how they're running the business.
Sure. Yeah.
Right. And again, it might seem okay now because you're just talking about what kind of restaurant or what kind of business, and it sounds interesting. But then as you start going on and you start saying, how do I invest the money? Are we profitable? What's my goals? They get misaligned quickly. So I think the second big one is really making sure you understand the founder, what's their incentives, what's their goals, and how is that going to sort of match your expectations as an investor.
Sure.
And look, there's investors who put money into, I don't know, football teams or bars or restaurant, and they are investing more, not for their own money. It could be for social purposes. It could be for fun because it could be social. That's okay as well. as long as everyone's sort of roughly aligned as they go in.
Yeah. So even on the founder level, it's about alignment. Yeah, interesting.
Yeah.
So let's tack again and move away from the world of investment
Sure.
and let's move towards how, as an SME, you can get the most out of either your investors or non-execs, advisors, etc. Because there's such a plethora of setups, isn't there, from having paid non-execs
Sure.
in a role to an advisory board to chairman,
Yeah.
etc. And you've sat, in lots of different positions. What have you seen work really well, and what are some of the setups that you would advise avoiding?
I don't know. I don't know if I think one setup's better than another, right? Meaning, chairman, non-exec, advisory board, or even more casual advisor. I think all of them can work. I think the key to stick on maybe the theme of alignment is just because you can get the best person in your field, sector, whatever, to engage with you, doesn't mean they're going to be the best advisor, because they might have the best CV, they might have the best network, but if they're not going to use it, it doesn't really matter, right? It might help you because you can, I don't know, put them in a pitch deck or in a website. But actually, when it comes down to it, are they going to get you a meeting? Are they going to spend time with you as a founder and looking at your strategy? It's really crucial that they're willing to do it. So you need to balance. You don't want to have just your really hard working people who know nothing about your business or your area, because they're not maybe adding a lot. And you don't want the other extreme of someone who has incredible, again, CV and history, and don't have the time or inclination to really spend the time. So you got to get that balance, I think, do it. Part of the way you get that balance is to have that conversation about expectations, right? And so some people might say, I really like the idea of a title, chairman or non-exec or whatever it is. And so sometimes that title goes with expectations. A lot of people I run into now will say, if I'm going to do advisory roles, I really want to be invested. All right. Because if either I want to be paid as an advisor or I want to be an investor. And that's really, again, crucial, because sometimes the best people, obviously they have a lot of demands on their time, and they might want to say, okay, you're SME, you can't afford to pay me as a classic advisor. But if I have equity or options, et cetera, then we're aligned, and I'm much more willing to spend my time on that. So that's the way I would think about it. I don't think there's a right answer, but I think from the starting principles, having these people around you in some form or another is really crucial.
Yeah. I mean,
it's just makes all the difference in the world. And I think the process of figuring out who would be your advisors, writing down who are the 50 people that I know that might help me, and thinking about what kind of role or how would I ask them for help, also might kind of clarify your business thinking a little bit.
Yeah.
Because you might think I have a great idea, but actually when you look at that list of 50, you think none of them really can help me here. And then you're going to start to think I'm a little bit on my own here. And that's not impossible, but it does make it harder. So I think, thinking about that when you're sort of starting out is really crucial. But I think in small businesses, like I said, compared to large, it's really essential to do it in some form or another.
Yeah. No, I mean, I might put my case forward for our setup, because I think it works really nicely. We have a panel of 6 or 7 meet once a quarter. Conversation's quite strategic. I would say the advisory board has really come into its own during times of near crisis. I'm thinking about a very memorable session, our first online session pre-COVID, where as a young founder, I had people that had been there and done it, seen 2008, seen crises left, right, and center, and just that calmness and just a gentle kind of guiding hand to say, Adam, what's going to be important over the next 12 months is this, that, and the other. And you go, okay, I get it. And your team they need clear leadership from you. They need you to step up and give them a really clear direction, perhaps, or whatever it might be. Actually, that external insight from a helicopter view, so important.
I also think what these advisors can do in whatever form is they provide a layer in between other business leaders, right? So just like investors, I don't know, investors, you talk to your friends about investors, everyone reminds each other of the winners, right? And, it's classic. Just like CEOs, I mean, there's a lot of networks of CEOs or founders, et cetera. But sometimes it's hard. It's hard to get a founder or CEO talking to another business leader to be totally honest about all their issues and all their struggles, right? If you have advisors, board members, et cetera, it's a bit easier. They're not so emotional about the whatever businesses they're involved in, the challenges, and they're one step removed, and it's a little bit easier for them to give honest feedback. So in those kind of situations, whether it's COVID or whatever the crisis is going to be, sometimes it's also a lot faster. You get diversity of businesses that maybe your advisors are involved in, but you can also maybe get a little bit more of an honest, quicker answer because it's not their baby. It's not their business, and they're maybe less cautious in terms of the lessons learned or the challenges they're facing.
Yeah, definitely. I think about first few sessions that we had, and I'm sat there with a frog in my throat, absolutely petrified. And there's a natural tendency to want to sugarcoat the presentation, the current state of play, and realize quite quickly that you're not going to get the advice, the real cold hard, Adam, that's completely the wrong thing to be thinking here, and unless you are totally transparent and say, oh, we're really struggling with this, and actually I really don't know what to do here. I would also say that a lot of the value that I've felt from the advisory board is outside of the sessions. It's in one-to-ones. It's picking people's brains and just picking up the phone and saying, just kind of ask me 50 questions on this one challenge, and I think naturally senior leaders do that. And lots of questions, context, and then often a good advisor will go, you got 3 options, 1, 2, and 3. My preference is 3 because of these things, but those just based on the facts that I've got. Amazing. So helpful.
And I think also I think as a founder, it's very difficult to watch other companies and other successes or failures, because your immediate reaction is, can I apply that to my business immediately? And I think as an investor or advisor, what you see is there's so many different paths, right? There's raise a lot of money because I know what I'm doing, go 100 miles an hour and it works. There's bootstrapped, I'm going to keep thinking, I'm going to be really careful. I'm going to go and find out what my potential clients want before I build anything, right? And there's everything in between. And I think when you're, thinking about your strategy or executing your strategy, it's hard to maybe just step back and say, oh, there is 4 or 5 different ways to kind of tackle this. And I don't have to, just because I've chosen this path 1 year ago, doesn't mean I have to stay on it for 5 years. And so I think that, stepping back a little higher level in the breadth and the confidence that maybe people have seen a lot of different businesses, just the sheer number of businesses and seeing winners and losers is really valuable. I think it can give entrepreneurs some solace that actually it's not so clean cut that there's only one answer. Right. Which is that kind of fear I think a lot of them have, to say, God, if I make the wrong decision here, or did I make the wrong decision? That confidence that says, as long as you're making progress and as long as you're running your business sensibly, you got to keep options open. And I think that's going back to what we talked about investing. I think that is maybe also one of the number one goals, which is, have you thought about your strategy and have you thought about your execution in terms of what that means for having optionality? That's really crucial. Because if you say, I've raised money, I've gone down this strategy, and unless I get 50% revenue growth the next 2 years, I'm out. Right? That you might take that gamble, but you have to really have thought, do I want to take that gamble? Right? And that's what I mean by, again, thinking about what are your options, but crucially aligning that to your investors. Because, the great entrepreneurs, the great SMEs, when you see it, it's a cliche, but if you said, describe your business now versus when you started, they're always different, right?
Of course,
They're always different. But to have pivoted and changed and gone with the market, you needed at every decision point, you needed to have the flexibility or the optionality to make a change, right? And that comes from sometimes thinking about, it could be thinking about your cash flow, thinking about what investment I need, thinking about, can I borrow money? Can I take on debt? Any of those different things. It's a little bit like really thinking about in steps, like a decision tree. And the best entrepreneurs are the ones who are, can make the changes, and SMEs can adjust because everything has changed. But it's crucially have thought in a few steps ahead to say, okay, if I'm wrong with these two decisions, could I adjust and could I go for different ways? And that's really powerful. And it's hard to do because that's not as exciting as sort of putting the big vision on the whiteboard on the deck and saying, I'm going to solve this problem. It's so amazing. It's so exciting. If you're to put on there to say, here's what I'm going to do. But if I'm wrong, it doesn't sound so sexy.
Yeah.
It doesn't sound so convincing, but that's what I think more advisory people can help you with.
Sure.
Because advisory people are giving you hopefully advice on the day-to-day running of the business. You're not always having to sell to them on, investment or as a client or et cetera. You can have a much more, give you a license to have a bit more of an open conversation and show a little self-doubt, right? That's natural. And that's just like therapy or anything else. You have to have that comfort that says, okay, it's okay to tell these people that I'm not 100% sure on this decision.
So,
right?
so as someone, let's say I've taken some investment from you, and you invested because of this plan, this idea. 6 months down the line, I discover that it's actually not plan A. Actually, it might be plan B.
Yeah.
Would your advice be that I should be, very straightforward with my investors and say, look, the evidence is pointing us in this direction, so we're pivoting, and be totally transparent with it, despite the fact that's different to what they invested in originally?
Yes,
Right.
Because ultimately, I think if you don't, what you're doing is you're slowly burning bridges with those investors, right?
Yeah.
Because the chance that those investors are going to give you additional capital goes down dramatically, right? Once they've lost that trust, it's very hard to repair.
So put on your big boy pants and have the difficult conversation.
Yeah, one of the ways to do it also is to make it a discussion, right? Even if you've kind of already decided, I think having, again, the humility of saying, here's what I'm thinking. I'm taking some feedback from my current investors,
involving them in the decision-making process.
Yeah, that's reasonable. But I think, look, SMEs or large organizations, we talked about the differences. One of the commonalities is you have to tell a story, right? So your example of I'm running a small business and I've got investors, and how I need to tell them a story that says, here's why I'm making these changes. Here's why I'm changing strategy or whatever it is. And you need to be convincing, right? You need to be convincing, certainly if you want their support, their advice, their additional capital, those kind of things. At a large organization, it's very similar, but in a different way. So in a large organization, let's say you've made some bets on the market or changes. You've gotten resources, but you have to understand who do you work for? Who controls your budget? And how long how long is my rope? How long am I going to get to take this bet?
Yeah.
It might be 3 months. It might be 3 years. But you need to be aware of it. And as you're going, just like an SME, as you're going, you need to be your management, your board, your whoever's in charge of that funding, those resources within an organization. You need to be telling them a story about here's the progress we're making. Here's the benefit to the business. Those kind of things. It's easy to go into 100% execution mode, right? I told a story, I got the resources or I got the money, and then I'm 100% executing.
Yeah.
And it's very easy to sort of think like that because you think that's the most efficient way to win. Often there's a gray area in between. And, obviously if you completely smash it execution-wise, that takes care of the story. But most small businesses, it's harder than that to just go 100 miles an hour and have such great success. And so bringing your investors, your partners, your senior leadership, and your staff, your employees all of those sort of counterparties, it's really important to bring them along as you go, because it gives you optionality and it gives you support, and it means you're more likely to have the support to run your business in the way that you think you need.
Yeah. Hey, look, I would love to carry on this conversation, but I think we're pretty much there. If I think back to the reason why we started this podcast and its whole purpose, it's about helping SMEs with the real challenge of growing and scaling. And it's so nuanced. There are so many factors, and I think what you've done today is just shine a light on the investor business relationship and how important it is to get it right. And there'll be people listening that go, oh, I wish I'd heard this 6 months ago. But equally, there'll be people that are walking into the investment process going, actually, that whole kind of notion of alignment has been put into sharp focus right now. And I think, you've advocated for it really, really well as the advisor relationship as well. So, thank you so much.
Sure.
Appreciate you've got a lot on your plate. So super grateful you could spend this time with us.
Yeah, look, I think it's a great thing that you're doing. I think it's good for founders and SME leaders to have it. And I maybe just leave it as saying, I think don't underestimate how impressive the leaders of these SMEs are. I think I spend a lot of time with professional investors and private equity and growth capital, et cetera. And they're all professional investors and they're all very successful. But in the end, they spend all of their time trying to find great leaders, right? And so I wouldn't forget that, because I think if you are really running your business well, you really are an expert in your area, there are always capital and investors and people who want to support that in the right way. And it's hard to do. And I think when you see the amount of people trying to find these great leaders, it should give them some confidence and really reward for how hard it is and what a great job they're doing if they're getting their business to be run successfully.
And if they're anything like me, they don't hear that very often. So no, I think that's really nice.
They hear the complaints more often. Yeah, that's true. That's true.
Brilliant. Thank you so much, Jonathan.
Absolutely. Thank you.
Thanks for tuning in to this episode of Behind the SME. Don't forget to subscribe and leave us a review. It really helps others find the show. If you want to get in touch, you can find our email in the description. Until then, keep building, keep learning, and we'll see you next time.